Hey guys, and welcome back to the channel. It's been a while since you've seen me post about DGOC because, well, DGOC didn't really post any updates. But today that changed because they have posted their interim results, so Q1 and Q2 of 2020. And that included some new information which I will be going through today. So we'll be going through the first key highlights, I'd say, and the first thing you'll notice is that their net production is 109.0. so in and of itself it doesn't tell you that much, but if we look at the previous exit rate net production, which was at the end of 2019, it was 94 or about 95.1, I believe. So this is like a 17-18% increase in production. That's mathematics out of my head, so don't pin me down on that one. So that's a very good increase. Something noteworthy is the exit rate production of the new acquisitions, is the EQT and the Carbon Energy. It's 18.7, which is higher than it was expected when they did their acquisition. It was expected to be 18.1. So this is another benefit that we will have in the production. Obviously it's not that big of a difference, but it's better than it being lower than what was expected. So going through that, here we see that they remain their legacy assets at about 70 MB OEPD, basically 1,000 barrel of oil equivalents per day, 8 consecutive quarters. So they have kept it steady consistently, while we were actually expecting a decrease of 4% per year. So this is very beneficial, and this basically tells us that whatever they're doing with the wells, their smarter well management, is actually doing a great job. Further, we have the average net production. So this is different from the exit rate net production. Why is it different? Well, there is a they acquired the companies in May, so that extra production has not been included completely in their net production, only in the last month. So the increase is minimal. And here you see that increase has, compared to the first quarter of the first half year of 2019, is plus 26%, but it's not that big of a difference compared to the second quarter of the second half year of 2019. It's only 1% extra. Makes a lot of sense because they just need to make sure that these acquisitions are up and running for a full period and not just for a month in the same period. Something noteworthy is this one is a bit difficult, sorry, a bit too far. It's the net income is only 18 million. What does this mean? The earnings will decrease significantly. So the PE ratio, so whether we think it's undervalued or not, is going to increase. So the company in the next few months is going to look like it is actually not undervalued anymore. However, we know the business and we can read this, and then we know that this is actually not the case. So the most important point is the first point, and this is the one that I will be going through, and this is what it states here. It says it includes there's a net operating loss. It includes a 110 million non-cash charge to mark derivative contracts to fair value. So what does this mean? To simply put it, the contracts that they have to sell their gas in the future against a certain price, well, because the gas price has crashed, like the underlying contract is like they can still sell it at the same price that they agreed to in the contract. However, the contract itself holds a value, and because the current gas price is so low, they think that, or like the accountants, I should say, believe that this contract, the fair value of the contract, is no longer what it was previously, but it needs to be reduced to a fair value. So that is basically what happened here. And in the third point, you can basically read something similar of that. I tried to put it in simple terms. It's a bit more difficult than that, but I think the most important thing to take out of this is that this is a non-cash chargeback. What does this mean? It affects the income statement, but it does not affect the cash flow statement. And if you follow my channel, you know that what I care about is the cash flow statement, because that's where the actual money is visible. And sure, the income statement can tell you a lot as well, but it's stuff like this that makes me question any income statement, because you don't know. You have to dive deeper to see what is actually happening in an income statement, and it could actually be the other way around as well. And that's what we had seen, I think, in 2019 or 2018 with DGOC, and you saw they had a operating profit because of that, and that's when the PE ratio went insane, and it was like 2 just because of something like this. So keep it in mind, you can get fooled by a PE ratio, and yeah, not a lot of people tell you this. Final point, well, not the final point, but another point is actually that they increased their dividends. So a 7% dividend increase, obviously a very nice benefit. And in a world where Shell decreases the dividends, BP decreases it, I believe, or adjusts it, and so on, like all the big boys in this industry have to decrease their dividends. And well, here you see DGOC is increasing their dividends in a period where actually people don't expect any dividend increases. And not just in this area, even in other areas, in REITs and stuff like that, nobody expects a dividend increase right now. So it's a very good sign. This point is also pretty interesting. It's just their cash operating expense. So how much does it cost? And they put it in barrel of oil equivalent. It's $7.05 right now, and last we knew it was $7.24. So they are constantly decreasing their cost, which is just a great sign. It's not a big decrease, it's only 2%, but still it's a decrease nonetheless. And what does this tell you? If the revenue stays the same, the decrease becomes an increase in income, and therefore an increase in the cash flow. So all in all, it's very good. I've already made a video about this. Yes, they're going to the premium segment. When can we expect results from this? Hopefully in the next month. They will be listed in the FTSE, like the FTSE 350, I believe, and that means that companies that, or the investors that follow that index will have to buy this company, meaning that there will be more people interested in buying this company. It's great. And we already talked about this as well. It's the acquisition of the upstream and midstream assets from EQT and Carbon. Other financial highlights, something I really like here is the cash margin. It has been increasing consistently. As long as it's above 50%, we are very lucky to be shareholders. This is just the comparison, okay? We sell it at this price, our cost is this price, and whatever the selling price minus the cost price is, or I should actually divide it because it's a percentage, that is your cash margin. So as long as this is above 50%, you have a great cash margin and you're very safe, even when the gas price is lower and your hedge is no longer sustainable or something like that. But obviously they hedge, so we can actually expect a similar cash margin in the future. Free cash flow 120 million, and here you see the dividends that they're going to pay out or have been paying out. And something I would like to add here as well is the free cash flow yield is 32%. This is insane. What this means is that it's basically a price to free cash flow of 3. So you can buy this company extremely cheap right now, and if you just buy a stock in 3 years, it will basically be guaranteed that you have your money back. Not effectively, because the free cash flow is not entirely going into dividends, but it will be paid back to you through dividends, through share buybacks, through debt repayments or payoffs or debt payments. So basically in 3 years you will have your money back. Still a great price to buy a company like this. I'm no longer, just so you guys know, I'm not buying any more DGOC because, well, you know, I loaded up on DGOC at the 90 mark. Not the cheapest price. I wish I waited a little longer, but yeah, you can't know that for sure. So all in all, I am set on DGOC, but nonetheless, I think this is great to see right now, and I hope in the future to have this free cash flow yield around 15%, because that means that the share price has doubled. But yeah, all in all, for now, people who are still interested in DGOC, I think you can't complain with this one. And what's other? Here you have some stuff about the the loans that they have, the revolving credit facility. Things that to note from this, and this is the final part, is they still have 220 million in liquidity, so they can borrow 220 more with their current agreements with the banks, and that means that potentially they could acquire more companies, or more assets I should say. Sometimes they acquire companies, sometimes they acquire assets, and this part is probably one of the most important part, because it's net debt to adjusted EBITDA of 2.2, and if you watch my previous videos, then you know that DGOC wants to have a net debt to adjusted EBITDA of or between 2 and 2.5, which means that it is on the lower end, and that means that they could actually acquire more companies with the liquidity that they have right now. So while we have already seen like a 15% increase in underlying operations through free cash flow, through production increase and so on, and through cost reductions, it is still possible that they are going to acquire more assets, and there's still a good environment to be acquiring companies right now, because they tend to be cheaper than what they have been buying them for previously. I did some calculations on that, but I won't bother you with that for now. I think on average, if you look at the underlying value, you can buy it half the price compared to a year ago. That's what I've seen. And if you look at the production, you can get it at a discount of about 20%. So production wise, so whatever you would be buying last year for an X amount of production of gas per day, well, now you can get that 20% cheaper, just the production. So that's all in all very good. This is basically the update. So dividend increase, great free cash flow, still a great company to buy, and still in September we can expect a certain share price increase, because people will be interested in buying it because they have to buy it, not because they want to buy it. It's a great distinction, and a great distinction between index investing and value investing, in my opinion. Anyway, that's it for today. Hope you guys enjoyed the update. If you have any questions, leave them down in the comment. If you enjoyed these kind of updates, please leave a like. And if you want me to look at any other company, feel free to leave any suggestions in the comments, and I will see what I can do for you. Thank you guys for watching, and I see you guys next time. As always, please keep in mind that I am not a financial advisor. The content on this channel and on my website is intended for educational and entertainment purposes only.